$10,000. That's not pocket change, that's a real milestone. And what happens in the next 12 months with that money could shape the next decade of your financial life. Get this decision right, and you're building a foundation that compounds quietly in the background while you sleep, while you work, while you live. Get it wrong, and you've handed years of potential growth to the market for nothing in return. So here's the question every Australian with 10 grand is asking right now. Where does it actually go? Not into the property market, not into a savings account earning 2% while inflation quietly eats your purchasing power, and certainly not into a crypto token your mate mentioned at a barbecue. The answer is more structured than that, more strategic, and honestly more accessible than most people realize. This is a full breakdown of how a serious, thoughtful Australian investor could deploy $10,000 in 2026. Not theory, not hype. A practical allocation built around how real wealth gets built, through diversification, discipline, and time. Let's start with the biggest mistake most beginners make before they even put a dollar to work. They assume $10,000 is either too little to matter, or they assume it's enough to bet big. It's neither. $10,000 is the perfect amount to build a diversified, growth-oriented portfolio if you know how to split it. And that split is everything. The allocation being discussed here breaks into 4 core categories: an Australian ETF, a global ETF, an optional NASDAQ exposure, and a small speculative position in crypto. Together, they form a portfolio that's diversified by geography, by sector, and by risk level. Let's walk through each one. The first allocation, roughly 20% of the total, or around $2,000, goes into an Australian exchange-traded fund. Now, if the term ETF feels unfamiliar, think of it like this. Buying an individual stock is like buying one specific lolly from the jar. Buying an ETF is like buying the whole bag of mixed lollies. You're getting exposure to dozens or hundreds of companies inside a single investment vehicle, with built-in diversification and typically very low management fees. For Australian ETFs, the most widely discussed options among retail investors include the Vanguard Australian Shares Index ETF, known as VAS, the Beta Shares Australia 200 ETF, tracked under the code A200, and the iShares Core S&P ASX 200 ETF, known as IOZ. These track the ASX 200, which means investors are buying a slice of Australia's 200 largest listed companies. Here's the honest limitation, though. The ASX 200 is heavily concentrated in 2 sectors, banks and mining. Commonwealth Bank, NAB, Westpac, ANZ, BHP, Rio Tinto, these giants dominate the index. That's not a reason to avoid it, but it is a reason not to stop there. A portfolio built entirely on Australian shares is a portfolio betting heavily on local financial institutions and commodity cycles. That's not diversification, that's concentration with extra steps. Which is exactly why the largest allocation in this $10,000 portfolio goes somewhere else entirely. The second category, and the one that deserves the biggest share of the budget, is a global ETF. And the reason for this is simple, and it should change the way Australians think about investing. Australia represents approximately 2% of total global share market capitalization. 2%. That means if an investor puts everything into Australian shares, they're ignoring 98% of the world's listed companies. That includes the giants of American technology, European healthcare, Japanese consumer brands, South Korean innovation, and everything the rest of the world's economies are producing. Global ETFs like the Vanguard MSCI Index International Shares ETF, VGS, where the Beta Shares Global Shares ETF, known as BGBL, give Australian investors exposure to thousands of companies across developed markets worldwide. Apple, Microsoft, ASML, Nestle, Johnson & Johnson, companies that move markets, generate billions in cash flow, and represent the genuine breadth of global economic output. The two ETF structure, one Australian, one global, forms what many financial commentators describe as a strong beginner foundation. The Australian component gives local market exposure and access to Australia's franking credit system. The global component adds the technology, healthcare, and consumer sector weight that the ASX simply doesn't have. Together, they cover far more ground than either alone. Now, the third category is optional, and that word is important. Optional, not essential, not guaranteed to outperform. But for investors with a long time horizon and the emotional discipline to ride volatility, a NASDAQ 100 ETF deserves consideration for approximately 20% of the portfolio, another $2,000. The NASDAQ 100 tracks the 100 largest non-financial companies listed on the NASDAQ exchange in the United States. The names are familiar: NVIDIA, Tesla, Alphabet, Amazon, Meta, Apple. These are the companies driving the artificial intelligence revolution, the electric vehicle transition, the cloud computing build-out. Their growth potential over a 5 to 10-year horizon is what attracts long-term investors. But the volatility is real. In 2022, the NASDAQ 100 fell more than 30% over 12 months. That kind of drawdown can feel catastrophic if an investor isn't prepared for it. Anyone considering this allocation needs to ask themselves honestly, if this $2,000 becomes $1,200 in 12 months, will they hold or will they panic sell at the worst possible moment? If the honest answer is panic, this isn't the right allocation. The fourth category is the smallest and intentionally so. Between 5 and 10% of the $10,000 total, somewhere between $500 and $1,000, goes into cryptocurrency, specifically Bitcoin and Ethereum. Not trending altcoins, not the project a YouTube ad is promoting, not whatever token is at the top of the speculative charts this week. Bitcoin remains the largest, most liquid, most institutionally held digital asset on the planet. Ethereum underpins the largest ecosystem of blockchain applications in existence. These are not safe investments. They carry significant volatility and regulatory risk. But at 5 to 10% of a portfolio, the position is large enough to be meaningful if the thesis plays out over years, and small enough to not derail the overall portfolio if it doesn't. The speculative nature of this allocation needs to be acknowledged clearly. Crypto markets have experienced cycles of extraordinary gain and devastating loss. Anyone entering this space does so knowing that outcome. The position here is sized to reflect that reality. Now, what about property? This is Australia. Property is in the national conversation constantly, and for decades it has genuinely built extraordinary wealth for Australians who got in early, who leveraged smartly, and who held through cycles. That story is real. But here's the practical constraint. Entering the Australian property market meaningfully requires somewhere between $50,000 and $100,000 at minimum for a deposit, stamp duty, legal costs, and a buffer. $10,000 doesn't get an investor into residential property in any capital city in Australia in 2026. What shares offer instead is a lower barrier to entry, genuine liquidity, meaning the investment can be sold quickly if needed, unlike property, which takes weeks or months, and immediate diversification without the concentration risk of owning a single asset in a single location. The common path for many Australians is to build a share portfolio while simultaneously saving toward a deposit department. The shares work while the deposit grows. Neither strategy excludes the other. But before any of this works, any of it, there are 5 mistakes that derail investors before they ever see meaningful returns. These aren't rare errors. They're the predictable patterns that repeat across beginners everywhere. Mistake 1 is investing money that might be needed short-term. A share portfolio can decline in the short run. If that $10,000 is actually needed in 6 months for rent, a car, or emergency costs, it should not be invested in the share market. The time horizon for this kind of portfolio is measured in years, 5 at minimum, preferably a decade or more. Mistake 2 is picking individual stocks or chasing hot tips. Individual stock picking requires deep research, sector expertise, and emotional detachment that most retail investors don't have, and statistically, most professionals don't reliably beat the index either. ETFs remove the need to pick winners and expose investors to broad market growth instead. Mistake 3 is waiting for the perfect time to invest. Markets are always uncertain. There is never a moment where every signal points green and every commentator agrees that now is the right time. The investor waiting for certainty is the investor who never starts. Dollar-cost averaging, investing regularly, regardless of market conditions, removes the psychological burden of timing. Mistake 4 is over-concentrating in high-risk assets. A portfolio that's 80% crypto is not a portfolio, it's a speculation. The allocation structure discussed here is deliberately balanced, with risk concentrated in the parts of the portfolio designed to carry it, and stability provided by the broader ETF exposure. Mistake 5 is investing once and walking away. A $10,000 lump sum investment is a starting point. The real compounding power comes from adding to that portfolio consistently, monthly, quarterly, whenever there's capacity. Time in the market matters. Consistency matters even more. Here's the truth about how wealth is built. It's not one brilliant decision. It's not timing the market perfectly. It's not finding the secret investment that nobody else has discovered. It's boring, disciplined consistency. Adding to the portfolio when the market is up, holding when it's down, and letting compound growth do its work over years and decades. $10,000 is a meaningful beginning. A global ETF covering the breadth of world markets, an Australian ETF capturing local growth and franking credits, an optional NASDAQ exposure for long-run technology upside, a small, disciplined crypto position sized to the risk it carries. That's the structure. The variables, which specific ETFs, which platform, how to split the exact percentages, those are choices each investor makes based on their own risk tolerance, time horizon, and financial goals. But the principle is what matters most. Start. Stay consistent. Don't panic in the short term. Add to the portfolio over time. And understand that $10,000 is not the end of the journey, it's the beginning of it. What happens after that first investment is what determines the outcome. The market will move. Uncertainty will return. There will be moments when the portfolio looks smaller than it did when it started. In those moments, the investors who hold, who add, who stay consistent, those are the investors who look back in a decade and see what compounding actually does. The best time to start was yesterday. The second best time is now.